stock portfolio or other investment accounts, even rental property that you are using for investment purposes. More importantly, have you had that experience at tax time where you have this sticker shock moment, where you are presented with this incredibly large, huge tax bill when you get your taxes done? And this is after you felt like you went through all the steps, everything that you were supposed to try and avoid a huge tax bill. If this sounds familiar, stay tuned. We're about to go through everything, all the ins and outs to help you avoid having that kind of thing happen to you again. Stay tuned.
Hello. Good afternoon. Welcome to another episode of Cigar and Taxes. Your host here, Layton Smith, with my partner, Stacey Smith. We're both partners of Smith Financial. We're located in Cherry Hill, New Jersey, and Waterbury, Connecticut. We're here today with another exciting episode of Cigars and Taxes.
Yes.
Today's episode is, what are the taxes on investment income? So we get this question a lot, which is capital gains. What are the capital gains taxes? That 0, 15, 20%, what are the thresholds, all that good stuff.
Right.
How are you taxed on rental income, whether you are a flipper, how is it, calculated versus if you're holding properties.
Right.
That's what we're going to get into today. Mm-hmm. We're sitting here now talking to you from Summers Point Cigar Lounge. This is Cigars and Taxes. So we have a couple sticks lit up already. We have a few drinks in front of us, and we are going to have a conversation today on the taxes on investment income.
Yes.
And before we get into all the good stuff, let's see. What is that purple thing you're drinking over there?
This is it is a strawberry margarita.
Strawberry margarita.
Yeah.
Okay,
I feel like I might could have put a little more in there, but it'll work.
Okay. Well, strawberry margarita mixed with Tabac cigar over there.
Yes, it's a Tabac cigar, Tabac Especial.
Stacey's favorites.
Yes.
I am sipping on some Macallan 12 today with finishing up a Romeo and Juliet, 1875, medium body, good cigar.
And you're always saying exactly what type of whatever you have in your glass.
Well, mine is simple. It pours right out of a bottle. You, on the other hand, with the purple and gold concoctions over there that you're mixing and making.
I do like to have my, I usually do 1800 or Patron.
I'm getting specific. What's in there? All right, good stuff.
Yeah, well, at this point in my life, I have to be a little more mindful about what I'm putting in my body.
Oh.
Okay.
Okay, so what we're saying is we're old and we only drink top shelf.
See?
Okay, that's what we're saying.
See,
all right.
That is my daughter's interpretation.
Your daughter's interpretation. All right.
Yes.
You said me and that oldest one, we think alike, right? Mm-hmm. Let's go ahead and start this episode, guys. All right. So, what are we talking about again? The taxes on investment income. Taxes on investment income.
Yes.
Stacey, let's take it away.
Okay. So, quick synopsis of what we're talking about when we're saying investment income. And we do get this question quite a bit. We're looking at interest, dividends, capital gains, rental property income, and tax advantage accounts. So we're also going to be talking about some common misconceptions about all of these and some key insights and tips that'll help with tax planning and maybe when you want to dump some of that stock versus not, and the timing of it. A lot of times you can play with the timing to give you a better result.
Well, this is definitely in Stacey's shoebox right here. So she is going to be controlling this particular episode.
I don't know, but I know you have
I'm just going to jump in and out here and there. All right, let's get it.
Okay, so first off, I'm going to list go over the different types of taxes, the ones I just listed, but I want to just go into them a little bit more. So interest income, we're talking about from savings accounts, bonds, other interest generating accounts. And it's usually taxed as ordinary income. So the same way that your W-2 and the rest of your income is taxed, interest income is
It's
kind of
taxed
just
at your
normal
ordinary
rate.
income bracket. Yes.
Yes.
Tax bracket.
Okay. Dividend income, that's the second type, can be classified as qualified or ordinary. Now, qualified dividends, nice, because then it's taxed at the
Capital gains
capital
rates.
gains rates.
So
Thank
it's,
you.
0, 15, or 20% rates,
A
depending
little
on
bit
the
better.
income.
Exactly,
Yeah.
and it's going to be better for you than when it's the ordinary
Which is your,
tax at your normal tax rate.
that's it. All right, yeah. So
Yeah,
that's
income tax
that's a
rate.
good.
Yes.
I do get that question often.
Right.
And people, they always hit you with, what's the difference between a qualified dividend and an ordinary dividend? And it's how they're taxed. So qualified dividends are taxed at capital gains rates. Ordinary dividends are taxed at ordinary income tax rates.
Exactly.
There's your
And-
answer. You got it. All right. Qualified dividends, capital gains rates. Ordinary dividends, ordinary income rates.
And then from there, we're sliding right into capital gains, which is basically the sale of investments. A lot of people do, it could be various types of investments.
Yeah, just a
whether
capital gain.
Just capital gains.
Yeah.
Property, your stock sales fall into that. I do have quite a few individuals who are traders, and they spend a fair amount of their day doing that. The day trading has become quite popular.
Yeah. Day trading always falls into short term.
It's going to throw in the short term because it's so fast.
So-
Nothing lasts for more than a year.
Yeah. So the big thing with capital gains is you have short term capital gains, which are taxed at the ordinary income rates. And then you have long term capital gains, which are taxed, there's zero tax up to 47.
0, 15, and 20%.
0, 15, and 20. So 0 is up to 47,000. Let's just say 50. 47,000. 15 capital gain rate. If it's 47 through like 518,000,
Something like that.
and then it's 20% if it's above 500,000, 518,000. So those are the capital gains rates. And
Right.
capital gains, you just broken into the two segments: short
Just the
term,
two segments.
long term.
That's it.
Boom.
That's it. But again, helpful to know, because if you're looking at selling certain stock, and if you have a portfolio and you're looking at that, if something is close to, you got a couple months before it's at the year mark, it makes sense to wait. It makes sense to wait if you can. So
You talking about deferring?
yes,
Okay, I got you. Understand. All right.
yeah.
Get into
No.
all these technical pieces here.
No, it's not technical. It's just, listen.
Planning.
I have-
Planning.
I have the saying, which is, it's always better in your pocket than theirs. Okay? So if there is a mechanism that's legit for you to make sure that there's more money going in your pocket than theirs, let's do it, man. That's a no-brainer.
That's it.
That's
So
it.
basically what you're referring to is close to the end of the year,
Yes.
if there's going to be a possible short-term gain, how can you plan so that you're taking so much of the gain so that you can stay in your same tax bracket for that particular year, and then the balance you receive in the next fiscal year?
So that's a different thing.
Okay.
I'm thinking that if you're looking at your stocks and you're thinking, you know what, I'm trying to get this stuff done on the house. I think I want to go ahead and pull something out.
You're talking about selling.
Yeah,
Okay.
yeah. I'm saying make sure that you're looking at how long it's been in there.
Got
Opt
it.
for the ones that have been in there longer and take a look and see, are they at a year? Are they close to a year? Can you wait a month?
Right.
So
So that you can be taxed
you
in a
could be-
long term versus
Exactly,
short
so
term.
you could be taxed at a
At the
preferential
preferred
rate. Right,
There you
yes.
go. The
Yes.
Warren Buffett rate.
Yeah. Just saying. Yes, so that's what I'm saying. But what
All
you're
right.
saying is valid too.
Yes.
Yes.
I thought that's what you were referring to, but all right.
Yes.
Like I said, this is your show right here.
All right, so then I have rental income. And we've talked about that quite a few times before. But, you know, it is, if it's a property that you're holding for income purposes or flipping, it's still considered ordinary income.
Yeah.
Yes. The likelihood is that it's going to be taxed at an ordinary income rate, meaning again, whatever your normal tax rate is based on your entire income for the year. Okay. You do get to take deductions on that income for your expenses for the rental property, mortgage interest, property taxes, supplies, repairs, cleaning. There's a host of other
Utilities,
things.
yeah, gotcha.
Yes.
All right, but it's still ordinary income.
It's still ordinary
Got it.
income what the net amount is.
That is, all right.
All right. Tax advantage accounts like IRAs, 401ks, contributions to those accounts are pre-tax, which is nice, and the taxes are deferred until you take distribution from them. Now, ideally, those particular types of accounts, you take distribution from them once you've reached retirement age, and you can avoid any penalty on that, but you still have to pay taxes on the income at that point.
It is ordinary.
And it's ordinary.
Yes.
Yes. If for whatever reason you end up taking out funds from those accounts prior to retirement age, you could be subject to a 10% penalty on the amount that's dispersed. So
There's always things you can do. Did we do an episode already on when you
have
pull in your
one coming up.
retirement?
We have one
we're
coming up.
Yeah, how you
Have
take
one
loans out or you do self-directed IRAs. Okay, we'll get into all that good stuff
Yes,
in that
we do.
episode. Stay tuned. Stay tuned.
Literally every time that we do one of these, we're touching on something that we could go in and do a whole episode on, or spend more time with. But we have a short period of
I
time.
think we're putting too much in each episode. It's too many topics. Too many topics to touch it in 25 minutes.
It almost feels like you're not doing it justice
You're
if
not,
you
yeah.
don't at least mention certain things. So that's the thing.
That's true.
Yeah.
And if we don't mention certain things, we might get all our buddies that are jokers, other accountants. You didn't say this.
So
you didn't say that. You didn't say this. You
Worried
didn't say
about
that.
you know,
I
so
know.
not worried about that. In any case, it is important to consult a tax professional when you're doing, when it's time to do your return and you have these items on your tax return. Two, likely throughout the year when you are making some of these moves. You know, if you're deciding what to do, I mentioned earlier, if you're needing to take out something and you're trying to figure out what's the best way to go about it and the timing of it, definitely reach out to your tax professional to get some guidance.
Some tax planning, some
Yes.
financial planning.
Yes.
That's all we're saying now.
Yes.
Yeah.
Yes.
Plan ahead.
Ideally, before you do it. Before you do
Can't
it.
plan afterwards.
Yeah, at a minimum before the end of the year, but honestly, it might be, if it's already done, it might be too late. At least you haven't.
Yeah. I mean, we're talking as long as it's not you're not in a hardship situation.
Right.
So.
Okay. Some misconceptions.
All right, here we go.
Some misconceptions about investment income. And we get people coming in, and I'm coming up with this list mostly based on our experience and what things have come up. But there's also been some other questions that came in that reference.
I mean, they're just coming in asking about the taxability
Yes.
of the investment income, and they
Yes.
kind of group it all together
Yes.
if all investment income is going to be taxed at
A preferred rate.
long-term capital gains rates. And it's like, no.
There's
You know,
rules
the
for this.
interest income
Yes.
is going to be ordinary. You're flipping houses. That's going to be on Schedule C. That's going to be ordinary.
Right.
It's not going to be taxed at capital gain rates, the long-term capital gain rates.
Mm-hmm.
But yeah, that's a misconception.
It is a
And that's
misconception. I've
normally
had
a
people,
long conversation trying to explain to somebody.
which is
what-
why I'm mentioning it here,
Yeah,
because
well, all the items that are taxed at ordinary income tax rate versus all items taxed at long term.
This
And it's
is
like, Man, listen. I'm just going to start a class. I want you to just register for it. Anybody got time to sit here and go through all that with you right now?
And then they're arguing with us like we're the IRS, like it's our book, our code
Oh,
that
no,
we
no,
did.
no. What they're saying is, well, how does Warren Buffett do it? It's like, look, man,
Yeah.
you ain't Warren Buffett.
No.
Okay, let's just start right there. Okay.
Wow.
You're not Warren Buffett. But all that being said, all of this is long term.
Right. Right.
Passive income.
Right.
Oh,
It is. Yeah.
100%.
It is.
Any
It
which
is.
way.
You know. The other thing is sometimes tax rates do change. So over the years. So you have to keep up to date with that.
That's true.
You definitely want to just keep in touch with your tax
But the
professional.
current
so you can-
long-term capital gains rates, they've been in place for many years.
for a while.
They when was the last time they changed?
Well, the long-term ones are fine. I'm saying in terms of ordinary.
Okay, gotcha.
Yeah, that's going to change a little bit for you probably each year if your income changes. So
So when you had that, what was it, the Tax Cuts and Jobs
Tax
Act
Cuts
that
and Jobs Act.
shuffled the tax
2008.
brackets at that point?
it did.
Yeah, so
Yeah.
that would have been a point where the short-term capital gain, well, short-term and ordinary, they would have changed. But outside of that, long-term's been in place for
Yeah.
a long time.
Right now, speaking of that, the Tax Cuts and Jobs Act, that is supposed to go through tax year 2025.
You know what? That is going to be an actual episode. The Tax Cut and Job Act, the sunset of it.
Yes.
That's one of the ones where we're going to have
Well, we have to wait
George
and see what's going to happen.
Dandridge.
Yeah. Oh, is he coming for
Yeah, we're
that?
going to have George Dandridge on for that episode.
Awesome.
So
Okay.
we're going to do something weird. Where we're going to be here and maybe we have a screen over there where we can see him, and we're going to be zooming him in. Going to have a good conversation
Bottom
with the
line
boss
is
man.
he's going to be with us.
Yes.
To chop it up here.
That's
Okay.
it.
All right. So some key insights that we want to make sure we, some of this I may have said, but want to just kind of highlight. Tax brackets and investment income. Whatever your tax bracket is for the rest of, so you have your return, you can clearly see what your tax bracket is. Ordinary income means that those investments, those dividends, that interest income, those short-term capital gains are going to be taxed at that same rate.
What rate you're in, what bracket you're in. It'll
Right.
be taxed at ordinary income bracket.
Yes, so if your bracket is 15, 21%, then
That's
that's what
where it will be
is.
taxed,
That's
yes.
it. That's it.
Now, that's not your effective tax rate, but that is your tax bracket.
Correct. And
We need to go into effective tax rates. We need a whiteboard or a green board, however you do it. You got a green thing here, you start pointing at and
No, you
the
could just
stuff
say your
pops
effective
up.
tax rate is actually what you actually had been withholding at, like what, for the
No, I mean,
year.
your effective tax rate is the actual average.
Yes.
But we'll jump into that. We won't
Okay.
do that now.
All right. State taxes on investment income. Some states do not have income tax, while others tax capital gains and dividends at different rates. You do need to check with your state, your particular state that you're filing with, to see how that is handled.
Well, everybody loves Florida, right?
Hey, everybody loves Florida. I think Texas,
Texas, yeah. I like Texas. I had a contract down there in Dallas a couple of years ago. Spent, I don't know, a couple of months down there. It's a good time.
Yeah, that's right.
It's a good time.
It's a little warm, I heard.
Different down there. Definitely different. Being a North Philly kid, spending time in Texas, definitely different, but I enjoyed it. We actually talked about maybe making that move at one point. Briefly.
Yeah, it was brief.
That was a brief
It was
conversation.
brief. We have had quite a few clients move down there, though, to be fair. So when it came up, I was like, maybe.
Yeah.
It is a little warm, though.
All right.
All right. I wanted to mention I think we already talked about the impact of holding periods. Oh, reinvesting dividends. Okay. This has come up with clients a few times where I have a client who's reinvested their dividends, meaning And feeling like that means that they should not be taxed on them. Okay? And then again, there's one of those sticker shock moments, which is unfortunate. I hate seeing that. At the same time, he didn't check in with me earlier in the year. I
A
would
lot
have
of times
told
you
him.
can't do anything about that.
That's true, too.
We had one client
That's
where
true.
they had, I think, a little over $1 million in account, and they had about a $22,000 dividend. They were sitting there like, I didn't receive that. I didn't get that.
That's it.
And it's like, okay. Listen, this here form says that you received it in this
Yes.
year. It is taxable in this
Yes.
year, but I didn't physically get it. So, okay, but it was added to the account.
Right.
Okay.
Right.
And you would think, why are you having this conversation? Like, you know that, there was whatever 1.13 in the account, and now it's 1.15. There's an extra 20,000 that's there.
Correct.
So it's there. You're being taxed on it. I don't even know why that comes up as much as it do.
But it does.
It does. It comes
Well,
up
it
a
comes
lot.
up because it ends
Because
up
they're
creating
saying I
an.
didn't physically get a check in my hand,
Yeah.
but your account grew.
And, right, and the thing is, it also comes up because, in effect, it is oftentimes increasing their tax balance due. And they're
Sure.
kind of not quite understanding or trying to resist that, that eventuality, that result. So,
That's it.
yeah, so that, it's,
Well, on a side note, this Romeo and Juliet is really, really nice.
is it good?
Mixed with this Macallan here.
Okay.
And as I said, we had Summers Point Cigar Lounge. We're sitting on a golf course and sound like they're having a whole lot of fun out there.
Yeah, it does.
So we're going to finish this up and go ahead and see
So
where the
we
party
can-
at.
Yeah, sounds good. Sounds good. All right. So the wash sale rule disallows a deduction for a security sold at less if the same security is purchased within 30 days before or after. 30 days before or after the sale. So it's sold at a loss if purchased before or 30 days before or after the sale.
So the wash sale rule, basically, you sell some securities and you buy, again, within the 30 days.
Correct.
That's when you have the wash rules that get applied. A lot of times you're not calculating this. Your brokerage house is going to calculate the wash sale rules. So most times when we get the clients in and we have the statements and we have
Yeah.
the wash sale and there's
It
questions
might
about it.
indicate it on the
Well,
form.
it always indicates
Yeah.
it on the form.
Yeah.
But most times when those questions pop up, I'm referring them back to the brokerage house.
Right.
We're not sitting there attempting to calculate the wash sale rules. That's
No.
like, not something I do.
Yeah.
But, okay.
Well, that's
but
what
all
your
that being
broker
said-
and his whole
That's
team
it.
is paid for. So.
Right, and basically, it's stated on a brokerage statement.
Right.
So I don't go into a ton of detail about it.
Okay.
We just, identify it, we add it on, as a calculated amount, it's for
Right.
the wash. And then if the client is in disagreement with what's coming up as the wash,
Right.
a lot of times we refer back to the brokerage.
Right.
They need to make that adjustment there. That's
Right.
not something that we're going to do in-house.
Exactly.
So I don't jump into the wash sale rule a ton.
Right.
We're just normally looking at it just like if you receive a 1099 or a 1098, I'm assuming that it is accurate and true.
That's true.
That's it.
So, and I think to be fair, with everything that we're just discussing today, the information comes out on a 1099 that is then presented to our team to prepare your taxes with.
Sure.
If there is something that seems amiss or not quite right, then it would be something where we'd be referring you back to
The
that
broker.
particular
And
institution.
just like
Yes.
international investments.
Yes.
Where, depending, we had situations where someone's double taxation, where they're being taxed by the foreign entity.
And
it's
the
coming,
US.
yes. So, but even in those scenarios, we are normally referring back to the brokerage house.
Right.
That's not something that we are attempting to work on or figure out.
Right.
If it seems like it's incorrect, we're making a call, we're talking to that brokerage house, that financial planner, and the client, and if an adjustment needs to be made, it's made on the brokerage house side,
Exactly.
and then they reissue the statements to us.
Correct.
But that's
Correct.
not something that we are recalculating or refiguring in the office. We actually
Right.
cannot do that.
No, we can't. But the only thing that we would be doing is to go over it with you in detail to make sure that, one, that you are clear, we're on the same page about what is being stated on
Yes,
there.
and what's
Particularly if
taxable.
you have, right, exactly.
Yeah, what's taxable in what jurisdiction if you're receiving a credit for it here. Okay,
Yes,
because it was
and it-
already taxed there.
Right,
Yes.
and then if that discussion results in more questions and potentially disagreement, oh no, my broker told me that it was going to be like this. Sounds like you probably need to reconvene with your broker to kind of go over that and,
Because the statement
Yeah.
says something different.
yes.
I don't care what he said.
and
what the
the-
statement says
And
is
the
this.
statements also are provided to the IRS also. So
Yeah.
it's not just that it's provided to you and we can some sort of way just negate it, just
No,
because
so, like I
that
said-
your understanding was different. It does need to be vetted out and potentially reissued if there is a problem.
Right, so it has to be amended if there's an issue. But like I said, we just send that back to the broker. We'll be on a conversation, on a call with the client and the
Yes.
broker.
Yes.
You know, explaining our position, the client's
Right.
position. And then the broker explains the real position.
Right,
And we go from there.
yes.
Yeah, so that's
we've
it.
had to
But
do
with
that a
all
few
that,
times.
the big thing is this, you are consulting with professionals.
You are.
You have a team around you. You have your accountant, you have your financial planners, and, they're looking at, how to grow the investment account. We're looking at the taxability of those investment accounts. That's the whole team right there.
That's the whole team. And the idea is that you come out with an accurate return and with things handled in the best interest for you and that
Hopefully-
line up with what the IRC code is
And
supposed
hopefully
to be.
we minimize the tax liability.
We'd like to.
If not, go ahead and cut that check. There you go.
Well, I mean, hey.
Listen, like I told
Listen,
you, I'm
if-
going to refer back
If
to the
they get
brokerage house.
it, if they've gotten, we have stories, we always have stories. I'm not
we're
gonna
not gonna do all
disclose
that.
any right now, but we have stories.
That foreign income, foreign interest income. Oh my God, there's some story. But they listening, so we ain't going to jump into all that. Those clients are listening. But all that being said and done,
But yes.
what will happen is we refer back to the brokerage house. We'll get the statements
Yes.
reissued, and then we'll go from there.
Right.
Yeah.
Right, and that's pretty much it. So that, I don't have and I think I've covered pretty much everything that I have on this.
I mean, it's been pretty meaty. I think. I mean,
It's pretty meaty.
we
Yeah.
we could delve more into the foreign interest side.
Do you want it right now? I mean, we can
that
also
could be
do
a
a
whole
whole
nother
nother
episode.
episode. That's
Yeah,
what I'm
definitely.
thinking. So that's the thing with what's here. I feel like to go into it significantly extra might be a whole
There'll be
nother
another
episode.
episode just
Yep.
on the foreign interest. That's
Yeah.
it. Yeah. All right. So
All right, so we've covered different types of investment income and how that's taxed. We went over interest and dividends, capital gains,
you
short
hit
and
the
long
common
term.
misconceptions.
We did. And we talked about a couple tips on, what you need to do or possible ways you could go to reduce or minimize taxes.
That's a whole other show too. We literally got like 3 other episodes. Every episode we keep talking about, we got 2-3 more episodes to do just on the
Well, we
topic we're
shouldn't run out
talking.
of material then.
That's it. So either way, listen, this has been a wonderful episode. We thank you for sharing time with us. As always, this information is intended for entertainment and education.
Yes.
Please consult your financial professional, your tax advisor, your CPA, EA, tax attorney on any of these topics you think that might apply to you. Any questions you might have, you can always send us an email at info@cigarandtaxes.com. If you like these episodes, this is what we're sharing, please hit subscribe somewhere down there. And and stay tuned for
Somewhere
more
down there.
episodes.
Okay.
We do
All right.
appreciate you spending time with us.
All right.
What else you got, Stacey? You didn't drink none of that purple drink.
I did have a couple sips, but I was talking most
So
of the
everybody that's
time.
listening can't see, but the
Oh,
people
okay.
watching,
Okay, I don't
those
know
are
what
Stacey sips.
I don't know what you want from me, man. Listen, I'm trying to go through this material here.
Listen, we're running through this material. They got a party going on outside.
That's what your problem is,
I
because you
see
hear the
all
party
the
going
smoke
on outside.
coming up. And it's just people walking up and down the golf course, and they're just calling us.
Okay,
Like, hey, y'all done yet?
all right.
Come on, come on.
Okay.
I'm joking.
All right, guys. Until next time, okay?
It's been great. Thanks.
Bye.